Thank you for joining us. Today's presentation features Benjamin Dietrich, Portfolio Manager on Lazard's Global Fixed Income team. Please note the information and opinions discussed do not constitute investment advice. Any securities mentioned are not necessarily held by Lazard Asset Management and should not be considered a recommendation or solicitation to buy or sell those securities. All opinions expressed are subject to change. With that, I'll hand it over to you, Benjamin.
We have been in a low yield environment for quite some time, and in the aftermath of the pandemic, central banks have accentuated that regime by reacting timely and forcefully to prevent a liquidity crisis from morphing into a solvency crisis. Monetary authorities slashed rates and committed to keeping them low until their inflation targets would be met. In addition, some of these targets have lately become more ambitious. The Federal Reserve, for example, is now interpreting her target as an average and not as an upper bound. Other central banks, namely the ECB, are currently reviewing their targets and are seen to make similar changes in the not too distant future. As you can see on the second slide of our presentation, the Treasury forward curve is priced for at most 2 hikes over the next 2 years. Interestingly, the long end of the Treasury curve tops out at around 2.5% in both spot and forward space. This corresponds well to the Fed's median dot projections that are also at 2.5%. These low yield levels are in place despite the correction that we've seen in the global bond market over the last couple of months that was initially driven by a recovery in break-evens and lately saw rising real yields as an additional propeller. But even after this aforementioned sell-off, we are still left with around $13.2 trillion in negative yielding debt, even in nominal space globally, and in real terms, more than 38.5 trillion, or 90% of the DM universe, are trading at negative yields. In summary, developed market yields are still close to historical lows and will very likely continue to stay low over the forecast horizon. Low yields can be problematic for traditional bond investors because they tend to foreshadow low return. Slide 3 shows the relationship between the current yield to worst of the global bond market on the x-axis and its 5-year forward return on the y-axis for a 15-year period. As you can see, lower yields are strongly associated with lower forward returns. The relationship's coefficient of determination is 0.73, a very high level. Therefore, it seems clear that in the current environment, bond investors have to get creative in order to achieve more ambitious return objectives. What can be done to enhance yield and thereby return strategically? There is no free lunch to be had in financial markets, and that holds true for the bond market as well. Yield can only be enhanced by taking on either moderation, more credit, or more currency risk. We firmly believe that diversification across all of these risk factors is the best way to accomplish more ambitious risk-return targets. And a global approach allows for a maximization of this respective diversification. Slide 4 shows the blue-chip issuer Toyota and some of its outstanding 5-year bonds across different currencies. As you may note, spreads are in a range between 20 to 70 basis points. While that is reflective of differences in investor behavior on the respective curves, it is also very likely due to lingering inefficiencies that still characterize the global bond market. It seems clear that stay-at-home approaches do not cut it anymore. The harvesting of global relative value has been very successful over the last few years and promises to continue to deliver alpha. Investing globally means dealing with foreign exchange risk. Stabilizing income means trying to remain in a fixed income volatility regime, which requires FX hedging whenever trying to access the global market. The good news is that over the longer run, hedging does not impair risk-adjusted return, and opening up a small portion of the foreign exchange exposure actually does not significantly increase standard deviation. As you can see on slide 5, opening up, for example, 10% foreign exchange exposure leaves portfolio standard deviation essentially unchanged, well below 3%. At the same time, some open exposure means the ability to make use of an additional tool for active management. A win-win for the portfolio. The perhaps most important way to stabilize income is to diversify across fixed income sectors. Slide 6 shows an equal combination over the most important ones. Like every balanced sports team needs attackers and defenders, so do portfolios. What we show here is a combination of the global government and corporate sectors as a defensive ballast, and allocations to global high yield, emerging market external, emerging market local, and emerging market corporates as yield enhancement options. We have combined major indices representing these sectors in equal weights. All indices are in their currency hedged version except for the local EM segment, where the OpenFX portion is the defining feature. The sectors have diversified risk profiles, and their combination provides investors with an attractive risk-reward proposition. We approximate the potential income level with the combined yield to worst and compare that with the dividend yield generated by the MSCI Global Equity Index. The combined fixed income combination delivers higher income at a fraction of the volatility. In short, it allows for a sensible income isolation. What is behind the attractive risk-reward proposition of combining fixed income sectors globally? Slide 7 shows a hidden dividend of diversifying across the sectors. Seen here is the average correlation of each pairwise combination of the aforementioned fixed income sectors over a 10-year period based on daily data. While the correlation is volatile and at times tops out around 0.8, on average it is below 0.4, and we have seen it structurally move only very moderately higher over the analyzed period. Another part of the explanation may also be an inverse relationship of credit spreads with inflation. Using a blend of BBB and BB US corporate spreads since September of 2002 and comparing their change to the change of the monthly US consumer price index yields a correlation of minus 0.32. Higher inflation prints are associated with lower credit spreads, which makes sense because higher inflation should also be associated with higher growth, which tends to support spreads. A caveat is that this may only hold in an environment where inflation is broadly subdued, as it was for most of the last 20 years. Yet, in summary, our analysis suggests that diversification across fixed income sectors, currencies, countries, and maturities works well to stabilize income. Finally, on slide 8, you can see the results of a backtest that shows that over the last 10 years, the aforementioned combination of fixed income sectors would have delivered a 4.4% return with a standard deviation of only 3.7%, which implies a Sharpe ratio of close to 1. A similar combination is likely to return a little less going forward, with the effective yield now being below the average historic yield, and when keeping in mind how yield levels and forward returns correlate. However, a yield of 3.2% compares very favorably to the dividend yield of 1.8% currently offered by the MSCI World Equity Index. And it is important to note that we stay in an entirely favorable volatility regime by sticking to bonds. The average portfolio quality of the combination of fixed income sectors also remains comfortably in investment grade space. Finally, it has to be mentioned that this fixed income combination consists of allocations to passive indices whose characteristics and performance can further be enhanced by active management. In any case, the $50 trillion in market value of the underlying universe allows for the generation of plenty of relative value and therefore also of positive active return.